We just had the largest bank failure since 2008 and second largest ever. All thanks to Silicon Valley Bank, who had in its books $160 billion of funds. To quickly illustrate to you how much funds they had available, I will just quickly dab into my savings. So this is the amount of funds they had available. Silicon Valley Bank's collapse explained in 1 minute. This bank primarily focused on venture capital and startup companies. These companies received a lot of funds during the pandemic due to the money printer and easy money. These companies deposited a lot of money into this bank, and the bank invested big portions of those funds. However, in this scenario, this bank failed to anticipate higher interest rate environment. Clients all of a sudden needed more funds available to pay their employees for wages, especially in the high interest rate environment. It's costlier to do business, so they tapped into reserves, and all of a sudden the bank found that they don't have enough funds to process the withdrawals. So they started to sell their stocks. Additionally to that, they started to sell portion of their assets, mortgage-backed securities. And as we know, when interest rates go up, the bond value or mortgage-backed securities goes down. Basically, the bank suffered a runoff within a 46-hour period. So now the FDIC took over the 16th largest bank in the United States. The good news in America, the deposits are insured by FDIC up to $250,000, and in this specific scenario, the Fed, the Treasury, and the FDIC just promised that they will make sure that the deposits will be paid in full, even over $250,000. They just created a new $25 billion fund to make sure this happens. So this is kind of a bailout that happened to make sure that there will be no mass panic in the banking system, and there will be no ripple effect on our economy.